I hope you're living the life that you want to. I hope you're happy. I hope you're kind to yourself. More importantly, eating properly, sleeping properly. You're kind to your family and friends. You're kind to your animals, and you're kind to just people in general to make this world a better place. The other night, I interviewed an incredibly interesting young fellow. His name, I interviewed him on my YouTube, and it'll be coming out in the next couple of days. His name is Andre Polgar. And he wrote this book, he's not even 30 yet, and he wrote this book, The Age of Anomaly, Spotting Financial Storms in a Sea of Uncertainty. And he's got a YouTube channel called, 1 Minute Economics. And honestly, this guy's got a PhD. He's a seriously bright guy. I'm not kidding. He really impressed me, I have to say. And, you know, his view of the world is very similar to mine. I believe that it's going to start, obviously, with trade wars, obviously in the States and what's going on with China, and eventually interest rates are going to go much higher in terms of the current yield, and basically the base curve of the corporate funding curve, the cost of credit is going to go higher, the yield curve is going to get steeper. In other words, long rates are going to be a lot higher than short rates. And I believe, this is my personal view, and this is not financial advice at all, but I believe that will precipitate, obviously, a higher base yield curve. And with a higher base yield curve, equity markets do sell off, because equity markets are valued on net present value formula. And basically, if the denominator is lower, in other words, if the yield is lower on the interest rate, the price, the overall price, say you've got 10 divided by 1, the price will be 10, but if you have something 10 divided by 2, the price will be 5. And so ultimately the price of equities going forward will be lower because the bond yields will rise. And ultimately my personal belief is equity markets will come down. They look very toppy to me. It's my personal belief, not financial advice. The Dow from 09, 08, when we had that big incredible sell-off, and I was actually working there, the Dow went from 6,200 to about 26,000 in the space of 10 years. Now, most of that move up in the equity markets, particularly the Dow, has been on cost cutting globally. It hasn't been on new revenue accumulation. It's actually been on cost cutting. So, which means the price earning ratio has been going up, the price over the earnings, but the thing is the earnings haven't actually been going up. The profit and loss has been going up, and the way you get the profit and loss going up is have the same revenue, but you cut your costs. You see what I'm saying? So basically, profitability can go up, but it depends on how profitability is going up. And I believe a lot of corporates in the Dow or in the S&P, the Standard & Poor's and the S&P, had been going up simply because costs have been cut. And interesting enough, Andre approached me because he wanted to, get a lot more marketing re his YouTube, and he's done this book, as I said, this book up here, which I'll put up, The Anomaly of the Age of Anomaly, and it's an absolutely fascinating book. It's about economics, economic history. It's about, markets going up and markets going down, and we think very similar. With markets going down, the fiat markets, particularly equity markets and foreign exchange markets and bond market prices going down and interest rates going up, it's going to create a lot of opportunity in the interest rate market. So what I want to do is just play you a little bit of this video. I have promised Andre I'd put it on around the 5th of August, because he's basically doing his big marketing thing around the 5th of August to the 12th of August. And on his website, 1 Minute Economics, he's got goodies to give away, which include 1 Bitcoin. But this guy is really, for a guy that's only 30, not even 30, I mean, he's pretty amazing. And seriously, he impressed me. I'm very impressed with this guy. He's a rocket scientist. So I want to just play you something, and then I'll come back to what I want to talk about, which will be, obviously about the opportunity in the cryptocurrency market, what it might mean if there's a collapse in the Dow and that sort of thing. Cheers, guys. Won't be a sec. Sorry, guys. I just tried to record over that YouTube, not YouTube, that recording, but it didn't come through with the volume. So I need someone on the IT side to help me, which is sort of annoying. But look, I'll put that out in the next couple of days. Today's the 30th of July, and that interview with Andre Polgar goes for about 40 minutes, and it's a seriously interesting interview. So what I want to talk to about today is, and look, I was on the same page with this guy, seriously. I want to touch on the US debt, which is huge. I also want to touch on the US equity market. I want to touch on very generally the trade wars that are potentially happening with China and what that means very simply, but also what that means for cryptocurrency markets. And pretty much some people have asked me about the special drawing rights as well, which I want to touch on that as well. So, but the first thing I want to start with is the US debt. And US debt is huge. So we're just going to go to a page which a lot of people probably don't know, but I used to look at all the time, and I still do. And I just want to take you through that page, the US total debt, and it's basically running every second. And the reason why that's relevant is the Chinese basically fund US debt, and they fund it by buying US dollar treasuries and US dollar government bonds. So basically the Chinese and the Japanese fund the US dollar debt by buying their bonds and buying their treasury notes. Won't be a sec with this. Hi, I'm back again. So if we go to this page, www US Debt Clock Organization, it's basically an overall US debt page, and it's basically instant, and it's ticking over all the time. So if we look at the total US debt, it's basically, what's that? It's 21.293 trillion. Debt per citizen is 64,000, not nearly 65,000 US dollars. Per taxpayer is 175,000. We keep going down. It's got the largest budgets in this debt, which are Medicaid or Medicare, as you say. Defense war spending is huge. Again, what's that? 616 trillion. Income security, another 294 trillion. Net interest on debt is, that 306 trillion. The numbers are so huge, seriously. The total interest on the debt, the interest on the debt that has to be paid is basically 8,000 odd per citizen. And the population, obviously, in the US, which I think it will say it here somewhere, is about 320 million, I think, which, here we go, 328 million. It's got income taxpayers, so less than about a third pay income tax, 121.62 mil. Excuse me, private sector jobs, self-employed, union, government employee, 23 mil. US workforce is 155.762 mil. This is a really good statistical thing to have a look at, because it really gives you an idea of just exactly how the debt's formulated. And effectively it tells you also the amount of people that are on food stamps, prison inmates. Prison inmates is 1.48 million. This gets updated by the day, by the second. It's also looking at people that are on, got student loans and that sort of thing. So it looks at student loan debt. Gosh, that's a lot. Student loan debt is 1.5 trillion. God, these figures are so big. It's really hard to work out just how much. These figures are huge. It's got currency and credit derivatives. Also, it's got the amount of people that are on benefits. Here we go. Social Security is 976 trillion. What else we got here? So have a good look at this, because it's a very, very telling thing. But it's basically this huge trade deficit to China, 392 trillion. The US trade deficit, 826. So a lot of that is to China, the money they owe China on the goods that they buy from China. And if you keep going looking at this, you'll find also basically how many people are on welfare payments and everything else. So what it is, it's very telling from an economic point of view, because basically says of the 328 million people the 328 million US population, only 155 million are working, and basically this much are not in the labour force. The median income is 32,000 US, which is not a lot, I have to say. And basically, it's got people that are living in poverty, which is 38.78 million, which is a lot. People that are on medical care in rollies, I don't know what that means, 57.7. Veterans are 20 odd million. So basically what it means, people living on food stamps, which is 39.123. So that's a lot. The ratios are very high. But ultimately, what you're looking at here is this overall debt figure, which is the US national debt, and that includes everything. And it's very high. And as you can see, as a figure of their GDP, it's actually getting higher and higher. It was there, now it's there. I don't know whether that's quite right, but basically what that means is the US debt has to be funded by offshore investors, and the main offshore investors, as I said before, are Japan and basically China. That's pretty much it. I hope that's recording. Gosh, I'm not having a good day today. So that's the main thing. And if we go to, so just keep that debt figure in mind, the 21 trillion. If we go to the US bond market, the federal government of the US, the central funding authority has to issue heaps of bonds to basically fund their negative interest rate story, their total national debt, which is a lot. So per citizen, it's 65,000 nearly, but per taxpayer, it's basically 175,000, which is massive. So what the US has to do is basically get that funded by overseas investors, and basically the total debt, this is probably current figures, this is a bit low because I think it's Q1 2017, but total debt for everything, corporates, treasury, whatever, was 39 trillion. If we go to just government bonds, it looks like it's about 20 trillion. And that pretty much is what we're talking about with the overall national debt. The national debt is 21 trillion. So it's pretty evenly balanced. So if the Chinese and the Japanese are funding this debt problem, it means that the Chinese are holding most of the US dollar treasuries and most of the US dollar debt. You see what I'm saying? And if there's a potential trade war between China and the US, the Chinese basically holding most of the US debt, or funding it, I should say, funding most of the US debt, can start not buying US dollar bonds or treasuries. And that's a real problem for the US itself. So if we go to this article, who owns the US national debt, we'll see, and these figures are pretty much May 2018, could change a little bit, but you'll see that China basically owns 1.18 trillion of US debt. It's the largest foreign holder of US Treasury securities. The second largest holder, as I said, was Japan at 1.05 trillion. And basically the third largest holder is United Kingdom with 699 billion. And then you've got obviously Brazil, 299 billion. Luxembourg, that's surprising, Luxembourg, seventh, wow, 209. United Kingdom, Switzerland, wow, they're big figures, yeah, 243 billion and such. And you've got basically Hong Kong, Taiwan, Saudi Arabia, they each hold 149 billion, 191 billion. So basically, the numbers don't add up to US debt of 21 trillion, so there will be a lot of other different smaller holders, but that gives you the general idea of the people, the countries that are holding the most of that debt. Now, I guess the relevance of that, and that's what I wanted to come back to with, cryptocurrencies and bring it back to that, and what Andre was saying, the young fellow that I interviewed, and that YouTube will be out in the next couple of days. If we have continued trade war with China, and as you look at this, and you look at what the US owes China in terms of trade, the figures are quite substantial. And where's that balance? So basically we've just got to find it. Gosh, there's so many figures here. Off memory, it was 892 trillion, I think, and the US owed China something like 398 trillion on this. If you go to that, there we go here, 826, is that trillion? Yeah, I think it is. God, the figures are huge. 392 trillion. If there is this trade war, China can absolutely lose that income from the US. And if they lose that income, then that puts pressure on the Chinese to sell US treasuries. Now, US treasuries, I said, fund the US national debt. If the Chinese sell US treasuries in bulk, they sell them on the open market, in terms of the bond market, it will cause the interest rate curve to go up in terms of yield massively. And because they're long bonds and short bonds, you'll see generally the interest rate curve go up in a positive way, which means long bond yields will be higher than the short bond yields. Now, what that will do is bring the US equity market down. Generally, as yields rise, the equity market will come down because valuations become extremely expensive and people will start getting out of equities. And how does that affect cryptocurrency markets? Now, getting back to cryptocurrency markets, if we see incredible volatility in US equity markets because US bond yields are going up in yield and US equity markets come down, we will also see the US dollar come down. Foreign investors that invest in US dollars and US dollar equities need to sell US dollars and US dollar equities. So by selling US equities, you're actually selling US dollars to come back to your domestic currency. So say I'm an investor in Australia, I run a global equity fund and I'm invested in Google, for example, or Facebook for that matter. I've had to buy US dollars to invest in Facebook, which is a US dollar share, or I've had to buy US dollars to invest in Google. Now, if I believe the US market's going to come off and I want to come back to Australia, I'm effectively selling US dollars and buying Australian dollars to come back to my base currency where I sit in an Australian dollar deposit in cash so that I'm not sitting in the equity market. Now, if that happens, we're going to see all the fiat markets, the traditional markets, all blow out and all underperform. And the question is, what will happen with crypto? And this is how it ties in very nicely to what Andre, Polgar and myself were talking about, which you'll see that YouTube very soon, about what we suspect will happen to crypto markets. And we both believe this. And again, this is not financial advice, but it's the first time I've met someone that's pretty much on the same page as me. So in my mind, the crypto market will outperform because it will be seen to be a natural hedge to the other traditional financial markets, being obviously interest rates, equity markets, and pretty much property markets and fixed income. Obviously cash is cash, but it will be seen to be a hedge to those markets. So if we get a major sell-off in equity markets like we saw in 2009, 2008 and 2009, we saw equity markets at their worst go down, some shares go down to zero, and we saw the market down 80% at its worst. We saw foreign currency in the US dollar come off dramatically. We saw yields change dramatically as well, and we saw the central funding authorities of the governments plough money into the system. Now, the thing is, I'm of the view, like Andre, if the central funding authorities, for example, the central funding authorities of the government, like the US government, are broke, which by the US debt opening position, which you've just seen, the US are equivalently broke. They're not rated AAA, even though they are rated AAA, they shouldn't be, because a AAA rated country should not have that amount of debt on their balance sheet. The thing is, if I was an individual and I had that much debt on my credit card, I would not be rated a AAA credit. And the reality is, holding that much debt is a big problem because the interest is going on all the time, clicking over, and that interest rate is increasing all the time. And the reality is, if the US had to pay out that debt, they wouldn't be able to pay out that debt all at once. So the thing is, they have a massive amount of debt, and that's a big problem. So if the equity market comes off and the central funding authorities, say the Federal Reserve in the US, and say the Reserve Bank here, and say other central banks globally, all don't have any money to put into the system to stop the fiat markets falling. You could find yourself in a position where the fiat markets are falling so quickly and so dramatically, for example, going down by 10, 20, 30%, 40% all at once, and the Federal Reserve's mechanisms to hold up the market, i.e. to try and reduce interest rates dramatically, or in China to reduce, in Japan to reduce interest rate dramatically, or put money into the system, doesn't work. Now, we have seen that situation in Japan, where interest rates got to zero, they got to negative, they tried to push so much money into the system, and the equity market never recovered. The Nikkei never recovered from 35,000, traded down to 8,000 or whatever, and then got up to 15,000, 20,000. Now, if you read Andre Polgar's book, I believe that could potentially happen, because in 2008, 2009, the equity market was broken. They put so much money into the system to support it. The Federal Reserve became the largest equity trader in the world. Their balance sheet blew out to something like $4 trillion. They bought Citigroup, I remember, at $2. They bought Morgan Stanley at $5 or something, and they made a lot of money buying US dollar equities to try and support the market. So where does this lead? If we get another financial market collapse like we did in 2008, 2009, which I believe, and this is my personal opinion, which I believe we will get, where it leads is you could find the volatility in traditional financial markets so large and so bad, because the central funding authorities do not have the money supply to be able to stabilize those markets, that you could potentially see a rush into cryptocurrency markets, because they offer a hedge, or they offer a market that is not going down by as much as traditional markets, or they're actually going up compared to the traditional markets that use SWIFT to generate cash flow. Now, we saw that as being a big problem in 2008, 2009. People borrowed money for equities and they couldn't get their cash flow into the market fast enough because of the settlement process with SWIFT that is slow. It takes forever to get money, cash flow, into your margin loan before you get stopped out on your margin loan, on your equity borrowings, because you don't have the cash flow. And so there is an argument to say, and I know this because I was working in the market, that SWIFT caused even more of a sell-off in equities because people couldn't get their cash flow, their free cash flow available. Don't forget, there's a difference on your balance sheet with your banks, available funds and cleared funds. If the funds are not cleared, you can't use them. So if the equity market's going down and you need to top up your margin loan, you need cleared funds. And if the banking system takes 3 days to clear your funds, you're going to get stopped out of your equity position. What that means is you would have been long equities, you bought equities, but because you've got a margin loan against it, you can't top up your margin loan because you don't have the cash, the cleared funds, and then you're forced to sell those equities. And that's what we saw in 2008, 2009. Subsequently, the market went down further in 2009. Now, if you had instant settlement like XRP, you wouldn't have had that problem because you would have been able to fund your margin loan and you wouldn't have had to sell your equity position. So where does that leave me? Where it leaves me is basically the cryptocurrencies that can instantly settle cash flow, right, are the ones that should be used. Now, XRP, as we know, can instantly settle cash flow. If people have access to instant cash, unlike SWIFT, the fall in these traditional markets wouldn't have been as bad as it was in 08 and 09, 2008 and 2009. Another thing, as you all know, and I'm not going to go into it, Chris Larsen is sitting on the board of the IMF, the International Monetary Fund, which has special drawing rights, which issues special drawing rights, which are pegged to the US dollar, the euro, Chinese yuan, Japanese yen, and pound sterling. And from what I can see, there's probably about 218 billion out there. Now, if those fiat currencies are so volatile when traditional markets are collapsing, you may find XRP is not volatile at all. And what I mean by that is, if businesses and companies and banks use XRapid, now remember this, they use XRP when they use XRapid, Ripple, the business, the company, takes on any price volatility within 2 seconds. They will take and absorb that price volatility. Also, you do not have counterparty risk. Now, in 2009-08, counterparty risk and credit risk became very important because small regional banks here in Australia were basically ready to fall over because they had no funding, because people in times of panic take out their money from the small banks and the small banks run out of money. And there was one bank here, which I won't say, on YouTube, but the government had to fund them out on Saturday morning, otherwise they would have gone broke. So, it's very important to have funding. But if you've got foreign currencies selling off dramatically and bond yields rising and equity markets falling, and you've got a system where there's no instant cash settlement or cleared funds, it's going to make the situation even worse. And that's where I'm coming with Ripple, XRP. XRP in times of extreme volatility would not see the volatility, and even if you do, you use the system of XRapid, Ripple take on any changes within 1 to 2 seconds, any price changes, and also there is no counterparty risk except for 1 to 3 seconds. So all it's an absolute positive to use XRP in times of extreme volatility. So just to recap, this market volatility could be introduced because of trade wars. Okay, the US government effectively has 21 trillion in debt that it cannot pay back straight away, like today, like this second. So effectively one could argue that it's broke, and a lot of that debt is accumulated for war weapons and everything else, or for social security or whatever it may be. The Chinese and the Japanese buy the bonds off the US government, off the Federal Reserve, to fund that US dollar debt or credit card. Now, if there's huge trade wars with China, the trade wars will come into play. The Chinese get $392 trillion worth of money from the US every year for their trade. If that reduces, the Chinese will not have the money to invest to buy US dollar assets, which fund the US dollar debt. If that's the case, they will start selling US dollar debt, which will bring generally the equity market down because the interest rates are going higher and the equity market is priced off interest rates as well. If that's the case, if the US dollar equity market comes down, you'll see the US dollar coming down because people hold US dollar equities and they sell US dollars at the same time. If the equity markets come down, there will be a run on cash because a lot of people have margin against their equity market positions and they need to top up that margin as the market goes down, and they need free cleared funds. If they don't have free cleared funds, it makes the market fall lower and faster. With XRP, if you have funding and liquidity, you can use XRP, but a lot of the banks are not doing it. Now, if XRP became the IMF standard currency, then you would not have this counterparty or credit risk, and you'd have instant settlement and basically any price difference with XRP for 1 or 3 seconds would be absorbed by Ripple if you use XRapid, I should say. So, we've got a theme here, we've got a story, and I hope you guys get something out of this. It is food for thought. It's my personal opinion. It's not financial advice. I'm not a financial advisor. I'm not a financial advisor on your risk, your tolerance, your risk position, or whatever. This is for educational. It is food for thought, but this is my own personal belief, and I do believe this could happen, and I do believe potentially it could be another equity market collapse. It's my own thoughts, and you know, have a look at Andre Polgar when that video comes out. But we seem to be pretty much on the same page. Anyway, guys, I hope you're well. I hope you get some value out of this video, and I'll talk to you very soon. Thank you.